Okay, Francis, let's go. What are you telling your clients about the North American economy?
I never thought I would say these words, but Premier Doug Ford stole my opening line. As the Canadian economist on the stage, does that make me the beaver? We were discussing who the beaver is. I spend a lot of time thinking about what many of us were all taught, which was when the US economy sneezes, Canada catches a cold. This was the Premier's line, which is what we were taught. And thus, if you are a Canadian economist, you spend 80 to 90% of your time on the US, and then you just add on a bit for, as we often call it, America's hat, Canada, that's what we call it. And yet, when I was sitting here this morning and looking up at this screen, US-Canada summit, I thought there's a pretty big elephant in the room. And that is that the US and Canadian economies are diverging, and they're diverging pretty substantially. And while Canadians have often hoped for their own economic identity so that we were not, following the sneeze cold developments, a lot of the developments and our rising domestic economic identity is becoming problematic, effectively. So there's a couple digs at economists today. We accept this. This is our cross to bear. About called recessions not occurring. That's only the United States that has escaped effectively recessions or things that look like recessions. Canada narrowly escaped one by decimal points. Growth is decelerating very quickly. Growth in Canada running about 0.5% year over year. In the US, 2.9, massive American exceptionalism. Per capita growth in Canada, so growth per individual has been declining for 7 quarters. So Canadians feel very much like they're in a recession, even if economists go on TV and say that's not the case. Retail sales declining in Canada, which is amazing because we're adding 200,000 people every quarter, and yet we're spending less on aggregate. Not so in the resilient American consumer. We don't see business investment happening in Canada right now. That's negative. And as a result, Canadian inflation is being brought down. It's now within the Bank of Canada's 1 to 3%, target zone 2.7, and short-term momentum indicators are declining versus the United States where inflation's running 3.4 and short-term indicators are accelerating. Why the divergence? A lot of it is rate sensitivity. Canadians substantially more debt. A lot of it is also structural issues. So Canada's housing market is increasingly problematic. It will take us a decade or longer to get back to affordable housing. We're building 60,000 homes every quarter, and we've got over 150,000 new household formations. The gap is growing every single month in Canada. Productivity, everyone talks about productivity. We are 40 years behind the United States. We have 40 years of underperforming in Canada relative to the United States. Now, it's not all negative. Canada does have some good things going for it, one of which is that our, believe it or not, our federal fiscal finances actually looking a little bit better. So the interest costs for Canadians, for every $100 the government takes in, it's about $11 towards interest. In the United States, $18. So we're doing a little bit better on that front. So why do I say this? It's not just because I'm the beaver. It's because as I'm sitting here listening to all of the really interesting things we could be doing on trade, our politicians' visions for what's ahead, I can't help but think that as the economy in Canada decelerates, it's going to take up a lot of focus. It's going to be very difficult to focus on long-term, big, structural, exciting things when we're struggling at home in Canada. There was an excellent quote this morning that if you're talking about democracy over the dinner table, you're not thinking about the cost of what or the price of food. That issue will become more relevant. We're probably also going to see a re-rating of interest rates. So Canadian interest rates may need to be structurally lower in Canada than the United States. That may impact the Canadian dollar, which also flows through to trade. That decoupling is really key. And yet, even within all these differences, there are still things that have impacted Canadians and Americans somewhat equally. And the big one that weighs on me is the cost of living crisis that has occurred for Americans and Canadians. Americans are seeing prices about 20% higher than they were before COVID hit, and for Canadians, 17% as well. And beyond all that, even though this economy is different than it was before COVID, there are some things that I believe to be universal truths. If you lose your job, you spend less money. If interest rates are higher, you borrow less of it because it costs more. And the momentum behind both the Canadian and the US economies does seem to be decelerating. This is going to be important in the next 12 months when it comes to these big picture discussions. The short-term economic momentum, I think, could be a distraction or, at worst, something that needs to be remedied more urgently. So I'll pause there.
We'll come back to and dig into some of those points you raised. Randy is the de facto American big picture analyst on the panel. That makes you the bull, I guess. Certainly from the vantage point of up here, when we look at what's going on in the US, you see US exceptionalism being thrown around as a descriptor again for the US economy. How do you see things? And you can sort of just, I guess, take the baton from Francis and sort of give your assessment of how you see the U.S. and the, I guess, North American economy unfolding.
Well, I would say that the differences that Francis highlighted are mostly, in my view, questions of timing as opposed to structure. I mean, there may be, as we get past the inflationary response in the United States, I mean, it's not impossible that there could be structural differences in the sort of appropriate interest rates between the two economies, but I don't think that that'll be great. And certainly right now, I mean, the American economy has been strong, but that is a problem. That is feeding our inflation, and you really can't. I mean, it's interesting. I think it's a measure of how long it's been since we've had sort of a robust response to a significant inflationary surge in the United States or the advanced financial economies, really, that so many people seem confused about what's supposed to happen or what might happen or how you might be able to constrain inflation while still having an economy that's running well above potential growth. That's not possible. So, which is one of the reasons why the Fed has signaled that interest rates are going to have to stay higher for longer. Now, when you consider historically, this actually hasn't been that long. If you go back to the Volcker inflation, it's kind of the last time you had an inflation that was this big, it took, and Volcker raised short-term interest rates to 20%. It took 6 years to bring inflation down from its peak to about 3%. And it took another 4 years to bring it down to 2% after that. Now, it's not going to take that long here because the pathologies that had developed are not as great, and the Fed responded much more rapidly than the Fed in the inflation of the 70s and early 80s. But it's not. It would not be unusual for it to be taking this long in order to bring inflation down. And one of the issues is that the economy hasn't slowed down enough. Now there is, I mean, many people in this room will be familiar with it. I mean, there have been analyses of the sort of refinancing wall that corporations and financial institutions in the United States are facing. One of the reasons why we haven't gotten back down to 2% inflation and the economy hasn't yet slowed enough is that lots of people aren't paying these higher interest rates. They haven't had to because given the speed and extent of the interest rate rises, people have said, well, I'm not going to refinance until I absolutely must. I'm not going to pay those rates until I must in the hope that they will come back down. So that actually perversely slows the rate of response of the economy to monetary policy. So, but over the course of the next year, there are a lot of maturities that will happen, and people will have to refinance debt that they may be carrying at between 1% and 2% to the current interest rates, and that's going to result in a significant increase in debt service costs, a further slowing of the economy. Whether that means recession or not, I absolutely agree with Francis. That's sort of a metaphysical question that doesn't really matter. It will mean a significant slowing of the economy, and it must mean a significant slowing of the economy to bring inflation down to the Fed's target.
I wondered if I could get you to take us inside the Fed to the extent you can, just to help people understand what sort of happened this year, right? We started the year thinking that a recession was imminent. The Fed was going to have to lead the world in taking interest rates down quickly. Here we are mid-year. people are starting to wonder if the Fed's going to cut interest rates at all, and Bank of Canada and the ECB and other central banks are now, in fact, cutting rates instead ahead of the Fed. So just, can you talk us through that? What's that phase? What happened? How did so many of us get it wrong? And what do you think the Fed is sort of thinking about now?
Well, so at the outset of this cycle, I was still on the Federal Open Market Committee, and there were two basic hypotheses that were perfectly reasonable to believe. They must have been, because I believed them, which was that interest rates would not have to rise as high to contain this inflation as they historically would have, and they wouldn't have to stay high for as long. Again, many of you will be familiar with sort of some of the rules that tend to guide central banks in the relationship between interest rates and inflation, which would have suggested in the summer of 21 interest rates should have been maybe 11%. Now, but the view was, for a whole variety of reasons we don't need to get into here, that you wouldn't have to do that this time. Even the most famous author of one of those rules, John Taylor, an economist at Stanford, said, no, that's not going to have to happen this time. Maybe 5%. So we're at 5.5%. I actually think, and I was one of the biggest hawks on the FOMC at the time, that's probably a little high for what was actually necessary to constrain inflation. The other hypothesis, that interest rates wouldn't have to stay as high for as long, really rested on a theory about central banks now communicate much more voluminously and granularly than they used to about what their intentions are, what their response functions are going to be, and that would allow the whole system to react more rapidly to changes in monetary policy because they'd know what the intention was, where the bus was going. That second hypothesis, I think, has turned out to be probably wrong. Certainly not to the extent that we thought at the time on the FOMC, or that many people on the FOMC thought at the time. For the reasons that I just explained, which is that I think that's probably true in peacetime, where monetary policy is moving more gradually. You're responding to smaller smaller concerns about the economy. That probably does, the greater communication of central banks probably does accelerate the ability of the system to respond to monetary policy. But when you've had sort of a very discontinuous jump in interest rates, it seems logical. It probably should have been logical in foresight, but in hindsight, it seems logical. That's going to slow things down, actually, as opposed to speed things up. It's going to take a longer period of time than we thought at the outset, and that's all we're seeing. This is not a historically exceptional length of time. So as the FOMC looks at, okay, well, what do we need to do? The key factor is they need to bring inflation down. That's their objective. And when people say, well, but if the economy goes into recession, central banks lower interest rates when an economy goes into recession. Yes, they lower interest rates when the economy goes into recession, unless they are trying to contain a generationally large inflationary surge, in which case a recession is a feature, not a bug. They don't lower interest rates until they're confident that inflation is coming back down to its target. And there are discussions out there about, well, maybe 3% is a perfectly satisfactory inflation rate. It might be. I don't think so. I don't think that the FOMC thinks so. I think a 3% inflation rate really is too high to ignore. If prices are increasing at 3% a year, you're going to say, well, I need to have higher wages in order to compensate for that. I'm going to need to increase my prices in order to compensate for the increased cost of my inputs. At 2%, we all ignored it. That's ignorable. So I don't think so. But more significantly, for the Fed in the middle of an inflationary response to say, we're changing our target, 3% is close enough for government work, will undermine its credibility going forward. A big part of monetary policy these days is herd psychology as much as financial intervention. And undermining that credibility is something that a majority of the FOMC is just not going to want to do. So they're going to need to see inflation come back down closer to that 2% target. Doesn't have to get to 2%, but closer to 2%. Staying at 2.5% for a reasonable period of time, a couple of quarters is going to be, a couple of meetings will be sufficient. And then And then they can start to lower interest rates. And I think that's, the reassessment of that original hypothesis, it's going to take longer, that's fine, that's normal. We're going to get inflation down closer to 2%. We're not stopping at 3%. I think that's, those are kind of the key factors. And we need to see inflationary pressures also abate, particularly in the labor market. I think those 3 factors are what's driving the majority of the FOMC.
Do you think it's possible that the Fed won't cut interest rates this year? It's a popular theory out there.
Well, I've thought that's possible for a long time. At the beginning of the year, when everybody was thinking there would be 5 interest rate cuts this year, I said that's just not how any of this works. The earliest you could expect a cut would be June, and I doubt that that's going to happen now. If you were to ask me to bet, I'd probably bet $15, but not 20, that there would be an interest rate cut at the end of this year, just given how inflation is evolving. But it wouldn't be at all surprising for there to be none at all.
Okay. Move on to our banker on the panel. We did a switcheroo and didn't tell Evan. This is actually Nadim Hirji from BMO, as a group head of the commercial bank. Nadim, you're in a good position to see what's happening on the ground, given this higher for longer rate environment we've been in, given the things that Francis has been talking about around cost of living, inflation, all of that. What are you seeing from your vantage point? What's happening? Is there some loan demand coming back? Is it still dead because of higher interest rates? Just what are you seeing?
Okay. First, Francis, and to all economists, I respect you. And I actually agree, Francis, with most of what you said. And it's exactly what we're seeing. The divergence in the US and Canada is real. I would have not guessed it a year ago, but it is absolutely real. And the divergence is fairly significant, and we're seeing it in our loan books as well, in how consumers are behaving. We're seeing it in the delinquency levels. So everything that Francis talked about is happening with our consumers. But there are differences structurally that I think Randy also talked about. You think on the consumer side, we don't have 30-year fixed rate mortgages in Canada, right? So that's the benefit that US consumers have to keep some stability in their pocketbook right now. Whereas in Canada, average tenure is 4 to 5 years on the retail book. And that means, over the last 2 years, you've already had 20, 30, 40% renewing at higher rates. So in Canada, the consumer is being hit deeper and faster than in the US. And so when I'm talking to clients, Canada, US, there is a difference. In Canada, people are hunkering down. There is a slowdown. There's a spending pattern change because nobody's defaulting on their mortgages. We as Canadians, we don't default on mortgages, right? We continue to pay. But that means unsecured credit card debt, lines of credit, vacations, all that, something has to give. In the US, sometimes I wonder if anybody knows there's higher interest rates or not, right? Nothing's changing. Our dealership business with, where we finance vehicles, especially high-end vehicles, nothing has slowed down there. The luxury goods are still going strong. If anybody's flown lately, planes are full, right? So the consumers are definitely behaving a little differently. On the commercial side, it's actually very interesting. And there's, again, some structural differences. Both sides of the border, I would say there's cautious optimism in the commercial customer base, probably more in the US than in Canada, but nonetheless in Canada, commercial customers with businesses want to grow and they want to invest. Onshoring is real, automation is real, productivity is real, all that needs investment. Both sides of the border where there is similarity is that everybody has done something fundamental with their business to cope. And what I mean by that is inventory levels are down. Working capital management has become extremely important. Keeping a bigger eye on expenses, especially when we still have wage inflation, which affects the smaller businesses even more. So customers have done a lot of things to make sure they're setting up their balance sheets for the future, because when rates do come down in Canada, when production goes up, when demand goes up, they want to be in a position where they can accelerate versus being front-footed, let's say, versus being on their back foot. In the US, investment is happening, but as you can imagine as a bank, rates went from 2-3% to 7%. Even if you maintain your risk appetite in a more uncertain environment, less customers in the commercial side are going to qualify, right? And when that happens, there's been a fundamental difference between US and Canada. Our loan volume is down on both sides of the border. In Canada, though, we're still seeing positive growth in our book. And that it's not as robust as 2 years ago, but there's still positive growth. So there is still investment happening. In the US, outside of the 4 G-SIBs, you'll see that the regionals and super regionals, generally the loan book has been flat. And which is contradictory to the economy being much better and faster in the US, yet loan book is flat. But I think what we're seeing in the US is that in the US, we have a lot of proliferation of private credit, which we don't have yet in Canada. And private credit has taken up a space within the US market, and I think it's here to stay. And as banks, we're gonna have to figure out how do we work together with private credit, partner with private credit, but there is different relativity of risk profiles, but there is a way to still partner. So I do think in the States, the loan volume and demand is masked because it's going in different places than it used to. I think it'll come back. One thing I would say, you know, Francis, I don't know if I don't think you mentioned it, but if rates do continue to go down in Canada, if consumer confidence does go up, if US stays higher for longer, I do think that this is a short-term cyclical event where the divergence is, and that over the next 2-3 years, we're gonna start seeing convergence again. And hey, who knows, you might even see Canada outpacing the US at some point, depending on how things go.
How are you seeing people respond to the rate cut here in Canada if it's not too soon? People need that trigger, and can we expect sort of a rush of new investment, or might people wait to see how low the Bank of Canada is willing to go?
I think from talking to customers, one rate cut of 25 basis points is not gonna do it. Sustainability and having more certainty is what's gonna do it. And so I don't think it needs 100 or 200 basis points before we see activity picking up, but I do think 50 to 75 basis points before you start seeing people getting more confident that, yeah, this is real and that it's here to stay. Because I think the biggest thing, if you're a commercial customer with a business that wants to grow, is the certainty, right? Certainty both ways. Are rates gonna go higher anymore, or are we it? And if this is it, then I make my investment decisions and ROI decisions based on this. And if it's going to come down, then okay, well, how long do I wait before it goes down before I make the investment? So it's that certainty that I think will actually fuel the economy more than how high or how low it is. It's a certainty that people are waiting for. But I can tell you that, you know, at some point, something's got to give, because there's billions of dollars on the sidelines that needs to get invested, right? And it can't sit idle. So what we have seen is, despite the rate structure, over the last 3-4 months, we are seeing M&A activity improve. And that's on both sides of the border. Our capital markets group, where Alan Tannenbaum runs, we have seen in the last 3-4 months good activity in that business on various parts of the business. And that rolls into our commercial customers and our private equity space, where they are starting to transact. Now, you know, what used to take 3-4 months to transact is taking 6, 7, 8 months to transact, because diligence is taking longer to get done. Structuring deals is harder. Agreeing on what the actual cash flow number is between COVID and interest rate, you know, the adjusted EBITDA numbers gets more and more confusing. So it's taking longer to get things done, but I can tell you, though, things are getting done. And valuation multiples are still fairly healthy from what we've seen. So we are seeing the M&A activity, it is actually picking up.
Okay. Beth, let's pull you into this conversation. You're so far away. People like me have been obsessed with the inflation story, the monetary policy story for the last couple of years for obvious reasons. But in the background, of course, trade policy has been going through something of a revolution too. Certainly it's far different now in its execution than it was when I was covering Randy at the US Treasury under the Bush administration, for example. What do you think an audience like this needs to understand about the way trade has changed? Because I do think there's certainly on the Canadian side of the border, there still is a kind of an idea that things should be basically free and free moving between the two countries, if not the world globally. I mean, obviously it's not like that anymore. So tell us a bit about how trade policy has fundamentally changed.
Great, and thanks so much. It's good to be here. I want to pick up on something Chris had mentioned earlier, and Francis, and then we'll come around to a more specific answer to your question. But Chris had talked about the first 6 months of the Roosevelt administration, and I think it's really important for people to understand, particularly in the context of how the Biden administration has looked at economic policy, to recognize that FDR assumed the presidency right as German democracy was failing, and that he was convinced that German democracy had failed in part because of economic deprivation to the middle class through the depression, the austerity measures that were imposed. So that was top of mind for him, and that informed his approach to economic policy. So really, at the core, if we're going to talk about preserving our democracies, which is important on both sides of the border, and also with Mexico, the third country in this three-part relationship, really have to be focused on making sure what we do is oriented towards working people and making sure that working people have economic security. So that informed the reaction to the pandemic. When we think about that in terms of trade policy, we have a worker-centered trade policy. What does that mean? We've got to be responsive to the lessons learned from the pandemic, from the Russian invasion of Ukraine. The version of globalization we had prior to then that wasn't really focused on workers, that created a dynamic where we were so deferential to the market, we found out the hard way that the market hadn't done things like take into account concentration risk or geopolitical risk. And so we found ourselves extremely dependent on a non-market autocracy for essential goods. That had in the United States, it's quite well documented, sort of the China shock and the consequences for working people in the United States. But that is a dynamic that we really hadn't solved for prior to the pandemic. So as we look at how trade policy is changing, we owe it in democracies to our people to make sure that the policies are responsive to our lived experiences. One of the challenges, I would really urge people to think about this, especially in this room, there has been a free trade ideology that the only right way to think about trade is that you should just take all your barriers down, and that was the way we approached trade for many decades. We've now seen the limitations of that. Again, as I was mentioning, some of the ways the market didn't really take those risks fully into account. So now we've got to have a trade policy that is responsive to those challenges. It's really important for the United States and Canada and Mexico to respond to this together, to be coordinated in the way we think about it. It doesn't mean that we're going to all have identical policies, but as we think about this 6-year review of USMCA for 2026, there's been a lot of conversation among the three parties about how to deal with non-market policies and practices, because all three of our economies, we are market-oriented economies and we are democracies, and that needs to be top of mind for trade policy.
Randy, you're not a trade guy, but could I pull you in on that? Because you served an administration that had certainly a different approach to trade. I mean, I have half a dozen China stamps in my passport because I was following Treasury secretaries and other officials to Asia so often. Is the thinking that Beth just laid out bipartisan? Is that sort of the way that Washington thinks about trade now, or are there some tweaks that you'd like to introduce to that worldview?
Well, I would say that view is, I would say that there are significant elements of both parties that would take that view on trade. And my own view on trade, which is sort of more the traditional Republican sort of heavy free trade emphasis, has also evolved. Back in the days when you were covering me, and people would talk about the difficulties that were imposed on workers through free trade, my view was, get a new job. I've had several jobs of entirely different sorts during my career. Just pull up your socks and get a job. And really, the election of Trump sort of brought me up short to say, what is going on here? And to realize, if you're a 55-year-old furniture maker in Hickory, North Carolina, globalization is never going to be better for you. I still believe that it's better for the country and it's better for your kids, but it's never going to be better for you. And there's no way that at 55 you're going to learn to code. I mean, it's just, that's not realistic. And so I do think that even those of us who have traditionally been very aggressive free traders need to be much more realistic and sensitive to the consequences for a country's population, and to adopt policies that allow that free trade to happen while nonetheless compensating for those costs.
Okay. Beth, we've got 2 minutes left, which probably means you're going to get the last word, but maybe I still call it NAFTA, and I'm going to call it NAFTA. The NAFTA renewal is coming up. I remember when that idea was put on the table, it was kind of met with a certain amount of trepidation up here, and something that Canada, at least from where I was sitting, looked like it was fighting against. Obviously, if it was, it lost that fight. So it's part of the deal, but I'm still not sure that we Canadians take that particularly seriously. So does the Biden administration take it seriously? Is Washington taking that renewal seriously? And then if you want to obviously respond to anything that Randy had to say about sort of his trade outlook, please take the opportunity.
No, I appreciate it. Maybe I'll come at it the other way, which is I really appreciate Randy's remarks. One thing we've really tried to focus on in the Trade Representative's office is that globalization is a thing. What we're talking about is the rules of globalization, and those rules matter. So going back to FDR, his original vision for Bretton Woods, there was supposed to be a third pillar. It was supposed to be the International Trade Organization. It had enforceable labor rules. It had anti-monopoly rules. I invite people to read it. It's a different vision of how you would globalize than what we defaulted to when the ITO Charter couldn't make it through the Senate because of hostility to organized labor. So when we look at it that way, we realize we have choices to make. So for our reflections on this 6-year review and the close relationships we have with Mexico and Canada, we've got to be willing to look at the rules of globalization and make sure they're fit for purpose for what we're dealing with in 2024, 2025, 2026. And make sure they're serving the purpose that we collectively want them to serve.